I'm thinking about selling one of my businesses. It's taking too much of my time, and I really want to focus on my other gigs. Sounds good. Have you thought about how much you can get for it? A little. My assets are worth about $150,000, and there's no debt on it. So I figure I can get at least that much. Is that little bar that's on the corner near the off-ramp to the freeway? Because that seems like an awesome location. It is. Actually, that bar does a pretty good business, but it's taking way too much of my time. I can understand that you want to sell it to free up your time, but I don't think you've thought enough about how much you can really get for it. Is it cash flowing well? Yes, it makes about $10,000 net cash each month. That's even after I take out some for me in the form of owner draws. I'm going to stop you right there. I don't think you should be thinking about selling it for a mere $150,000 just because that's where your assets are at. We need to talk. I think you could be getting a lot more than that, maybe 10 times as much. People buy and sell small businesses all the time. Unfortunately, many don't really know how to price it well. Today we're going to talk about different pricing models. So sit back and take some notes. Just like in the skit you just watched, when many people think about selling their business, they think about it in terms of the value of the physical things that they own, cash registers or building, leasehold improvements, office furniture, or what have you. This model has its place, but often it's not the appropriate model. But let's talk about this one for a minute. Let's look at this example. We have a balance sheet shown here. What sometimes happens is that people attach a market value to the various line items and think that that is the value of the company. That's what they should sell it for. If the buyer is only interested in purchasing the assets and not take on any liabilities, then the market value of the assets is their starting point. If the buyer is interested in buying the company as a whole, then the market value of the liabilities comes into play also. In my opinion, this market value assumes the business really is not going to continue. It's sort of like you're just going to sell the individual things that the company owns as soon as you buy the company. Normally, you expect the company to continue to perform and to continue generating cash. This model does not take that into account. This is sort of like selling it for scrap parts. If you have a profitable business and regular customers, that ongoing business is worth more than just the value of the equipment. If, on the other hand, your business is not performing well, this methodology might be appropriate. With that being said, let's take a look at a more sophisticated model. This model assumes that the company will continue generating cash. This model is for a company that is performing well. We call it a discounted cash flows model. The first thing that happens is the buyer calculates what the estimated cash flows are going to be over the next several years. Often, the selling company's historical and forecasted income statements are used as a starting point. The buyer then might make adjustments for things that are one-time items. These items are not expected to happen again in the future. One example is the benefit many received from PPP funds during the pandemic. The buyer would also want to take out expenses that may have been regular for the current owner, but are not going to continue once the sale takes place. This might include salaries for some higher level employees that will be laid off. This might include charges that are more personal for the owner, such as car allowances and other perks. Different financial analysts have slightly different ways to get to what they believe are the best estimates for future cash flows. A common approach involves using the EBITDA, or the earnings before interest, taxes, depreciation, and amortizations. Often this is a close approximation to the operating cash flows. Then you would apply your tax rate to the forecasted cash streams. The next step is that you need to discount the cash flows to the present day. If you haven't watched my previous video on the time value of money, I recommend watching it now. So when you discount the cash flows to the present day, this will give you a value for the cash flows, And if you are buying a well-performing business, this is really what you're buying. You're buying a stream of cash flows. In this example, we would estimate that the value of the company is about $600,000. This often becomes a starting point for the negotiations. The reality is that the buyer and the seller are not going to agree to a price just because it shows up on a spreadsheet. Both sides will explain why their proposal is better. The buyer may start with a price of $500,000, hoping to get a bargain. The seller may suggest that their well-known brand name and awesome location warrants a higher amount. The negotiations continue until both parties either agree to a number or they agree to walk away from the deal. If you are able to acquire information about what prices other similar companies have sold for, you might be able to use a multiplier formula. How this works: you start with some financial surveys. This is usually something you have to pay for or have your financial advisor obtain them for you. Then you make some observations about the relationship between the sales price and some marker, such as the revenue or net income, EBITDA, or free cash flows. You might find that similar companies have sold for a price that is 8 times the amount of EBITDA. That 8, in this case, becomes the multiplier. In our example, the buyer then applies the multiplier to the estimated EBITDA and comes to a suggested price. And as I stated earlier, this is just a starting point for the negotiations. In this example, the buyer has forecasted information for 3 years. He calculates the average EBITDA for this period. Then he multiplies the EBITDA by this number. There are different ways to use these multipliers. As I mentioned earlier, it could be used based on EBITDA, on revenues, the top line, free cash flows, net income, the bottom line. For these different markers, the multiplier will be a different number. This next model that I present really is a textbook model. However, it is usually most useful for publicly traded companies. It's called the Capital Asset Pricing Model, or CAPM for short. There's a lot of work that goes into using this pricing model, and it's beyond the scope of this video. If you would like more information on that, let me know in the comments below. There are some special cases that might require some additional calculations, such as if you're buying or selling commercial real estate for rental use, or if you're looking at high-growth tech companies. Often the high-growth tech companies may have low or negative earnings, but they're still worth something. So the basic process is this. You figure out what issues your company has, where it fits in. Then you use multiple formulas to set up goalposts, if you will. And by using different formulas, it will give you a more complete idea of what the company should sell for. Suppose you use the discounted cash flows model, and that came up with a result of $1.2 million. Then you use the multiplier approach, and it gave you a value of $1.5 million. That would suggest that a reasonable price is somewhere in the area of $1.2 to $1.5 million. Again, it comes down to the negotiation process. In transactions where there might be a great level of uncertainty about the future performance, often the buyer will require clawback formulas. This means that there is an agreed upon price, but if the company does not meet certain specified goals in the future, the seller will have to pay back some of the amount back to the buyer. Or the company will make the price contingent upon the company achieving certain performance milestones. This means that the seller would have to wait for some of the agreed upon sales price until sometime in the future when the company has shown it is worth that price. And to facilitate this, there is often a note payable created at the time of the sale. The buyer is promising to pay the seller in the future for the agreed upon sales price. If the performance ends up being lower than promised, then there is a deduction taken from the notes payable. Another thing you want to think about is if you're going to retain staff, including management or key personnel. you might want to have that in your contracts. So I covered this material pretty quickly, but it is sophisticated material. I would suggest you get assistance from an expert if you're in the market to buy or sell your business. The financial expert can help you with pricing, negotiations, or even the legal paperwork necessary. I hope this has been helpful. Thank you, and have a good day.